This man made $34 million in bonuses by selling insurance on toxic loans. He promised his company wouldn't lose a single dollar. But by 2008, his division lost $99 billion and nearly destroyed the world's economy. His name, Joseph Casino. The press would later call him the man who crashed the world. September 2008. Wall Street is in chaos. Lehman Brothers has just collapsed and now eyes turns to a different kind of giant, AIG, one of the largest insurance company in the world. AIG wasn't bank. It didn't make headline like Goldman Sachs or Bear Stearns. Yet in just a few days, this insurance titan lost billions and stood at the edge of complete collapse. The US government was with emergency $85 billion loan, but one. Because AIG's failure could be trigger a global finance meltdown. AIG founded in 1919. It grew into the world's largest insurer. Operating in over 130 countries, by 2007, it had nearly $1 trillion in asset and insured from homes and car to corporate empire. But under the surface, a smaller division in London, AIG Financial Product, was taking massive risk. It wasn't selling regular insurance. It was selling something called credit default swaps, a type of insurance for bond. These swaps were tied to risky mortgage bundles known as CDOs. And AIG believed these bonds were safe, too safe to fail. To put it simply, AIG was insuring mortgage debt. As long as homeowners paid their loans, AIG made money. But if the housing market collapsed, AIG would have to pay out billions. From 2007 to 2008, AIG insured over $500 billion worth of debt. About $78 billion of that was tied to high-risk subprime mortgage.
Today, 10 years later, they're still affected by the crisis, various people in different ways, but they're not as affected as they were in 2009 or 2010.
They didn't set aside much capital. They didn't hedge their risk. They thought default were unlikely. They were gambling without a safety net. And then the housing market crashed.
I can understand why people that lost their houses or lost their jobs or whatever may have happened to them feel that there must be somebody out there that was profiting from this.
By mid-2008, default surge. Those mortgage bonds began losing value. AIG's swap turned toxic. Losses mounted. On September 15, 2008, the same day Lehman Brothers filed for bankruptcy, AIG's credit rating was downward. That downgrade triggered a hidden clauses. AIG now had to post collateral to its swap partners. Overnight, it owned more than $30 billion. AIG didn't have that kind of cash. Its stock tanked, panic spread, and bankruptcy loomed. At the same time, AIG was losing billions in another corner of its business, security lending. AIG had lent out assets in exchange for cash and invested that cash in risky mortgage security. When the market fell, those investments collapsed. Investors wanted their money back, but AIG couldn't pay. In total, security lending cost over $20 billion in losses. Now AIG was bleeding from both sides. AIG was too big to fail. It was connected to major banks worldwide. If it collapsed, it would drag other down with it, like Goldman Sachs, Deutsche Tech Banks, and Barclay. All had exposure to AIG. So on September 16, 2008, the US government stepped in. The Federal Reserve gave AIG an emergency $85 billion loan. In return, the government took nearly 80% ownership of company. It was the largest corporate bailout in American history. Public outrage followed. AIG exits were caught spending bailout money on luxury retreats and $1 million in bonuses. Protest erupted. Congressional hearing grilled the company's leadership. But over the next few years, AIG restructured. It sold off major businesses and refocused on core insurance business. By 2012, it had repaid the entire bailout. In total, the US government recovered $182 billion and even made $22 billion in profit. The collapse of AIG taught the world that even an insurance company could threaten the global economy. It wasn't just bad luck. It was about unchecked risk, complex product, and blind trust in a booming market. Today, AIG services smaller, more cautious, but its fall changed finance forever. And it left us with hunting reminder. Sometimes the most dangerous company aren't the loudest. They are the quick giants hiding behind a promise.